Welcome back, everybody. We're back with another podcast here, Macros with Bros. I hope everybody's doing well. And yeah, we're starting to get into some earnings here. Last week, we already got a lot of reports. This week is going to be the big, big one. Not only earnings week, but also we get a lot of economic data. We get GDP, labor data, and so on and so on and so on. So. There's a lot of stuff to do, man. If you've been expecting, oh, we're finally getting a rebound, so everything's going to be chill now. Oh no, nothing's going to be chill now. It's going to be so much stuff coming in. But yeah, first of all, as always, how are you doing, man? What's going on?
Bro, I'm doing good, doing great. God bless you. I hope you are also doing good. Like last week, we had this gold trade, the short
Oh
3,500.
yes.
So it made the entire week. And we just went back to our research. And as you mentioned, this week's gonna be a big one.
It's
Not
heavy,
only
yeah.
on your side, not only on your side on the equities, but also on our side on macro with treasury funding and the BOJ job data. It's gonna be another insane week. Plus, are not allowed to forget Trump's wording. Like he comments every 5 minutes. So
Mhm.
we back in the
We get a
trenches.
we get another truth post every 5 minutes, then he gives another random interview somewhere. Yeah.
It's not, we are not back, bro. We are not back. We are still in the process between it's over and we are back. Yeah. Yeah, but how are you doing, bro? Like last week?
Yeah, so from the earnings side, we started earnings season quite strong. We had solid earnings, especially like the biggest contributors to or actually the biggest contributor to this positive earnings season start was Google. They had a crazy beat. They had a crazy earnings report. So from their side, it's still looking good. I will really be looking forward to Apple on Thursday after the close this week. Apple and Amazon, they're going to report Thursday, May 1st. And because those were also first, another more Mac 7 stocks, but they will be big in terms of China exposure or the tariff exposure. No, because as everybody knows, Apple is heavily reliant on China. Amazon already also said that they are pulling some orders from China due to the tariffs. We've been seeing today and over the weekend, we've been getting some headlines of the shipping companies, the container shipping companies saying that they are pulling back like 20 to 15 or even like 24%, I think, were Hapag-Lloyd and Maersk of less shipping container volume due to the tariffs. So those are the ones that I'll be looking for, especially with regards to the tariff impacts, Apple and Amazon. But yeah, there's so much stuff going on. On Wednesday, we got Microsoft and Meta, which obviously also will be big for the continuation of the AI story, the continuation of, all right, we're going to see increasing or continuation of the CapEx spending, which has been the biggest story for the last year and obviously into 2025 now as well. But so far, it's looking good. Google, they are
Just one
saying,
question.
oh,
Just one.
one more. Yeah, go ahead.
Yeah.
Yeah.
No, no, go ahead. Go ahead. Finish your point.
Yeah, just the last point to the idea that everything's been looking kind of solid now. Google, they started a huge buyback program, share buyback program. I believe it was 70 billion, 60 billion, maybe
70
something
billion
like
dollars.
this.
Yeah,
Yeah,
right.
70
Yeah.
billion, where they say, okay, we have the cash, we're printing money, so let's keep buying back some shares, create some shareholder value. So, yeah, go ahead.
Bro, what about Tesla, G? Like they reported shitty earnings and the stock
Yeah.
on Friday
Yeah,
shoot up
this is
by like
one. This is
9%.
one. What is actually going on? Like, the thing is, the expectation into the earnings report was, all right, we believe they are not going to have a good report due to the slowing in their sales. No, we've been getting all the sales numbers drop in Europe, 70% here, 50% there, and so on. So the expectation was, okay, it's going to be bad, but not that bad. This report is actually insane. They missed the analyst expectations by a huge amount. They had declining sales, like they had a huge miss on the report, but Elon Musk came through because I believe the market reacted kind of muted because they were expecting, all right, Elon Musk is going to pull through and give a big announcement in the earnings call. So we got the data and we got the numbers ne, after the close. And just based on the numbers, this would have been a huge short. This should have been a 10%, 15% down day for the stock. But we had two factors playing in. Firstly, the stock was already clapped and it was already priced in that they're going to have a problem or that they're going to have problems with their reports because as we've seen from the highs to the lows, from 500 to 250, the stock dropped 50%. So a lot of it was already priced in. This kind of deterioration in the brand image because it's kind of tied to a political symbol now more than just an EV maker and the problems with Elon Musk so active in the government and not active in Tesla. But then, firstly, no, a lot of was already priced in, and then secondly, Elon Musk on the earnings call came through, said, "All right, I will be focusing less on Doge starting on May 1st. So he has a few more days, one more week or so at Doge full time, or not full time, obviously, but Doge with a lot of focus. And then from May 1st, he will be focusing more back to Tesla and less on Doge. So this is kind of what all the analysts have been saying. And he obviously he doesn't want the stock to fall even further, so he kind of has to do what the analysts are expecting. And the analysts were expecting the only thing that can save the stock in the short term is if Musk says, all right, he will be focusing back on Tesla and less on Doge. So yeah, numbers, terrible numbers, but Musk came through and a lot was already priced in. But yeah, going from here, we're kind of in nowhere land because if the numbers keep going on this kind of bad level, then there is no recovering for the company because even at this 250 level, the stock is still insanely highly valued. Some say, or we say it's overvalued. Some say it's just optimistically valued. But even at 250, it was still crazily highly valued on the earnings they already had, and now the earnings are getting even worse. So it's kind of difficult to see where we're going to go from here, if they're going to get a rebound. But if we continue with these earnings, oh man, not no Optimus robot will save them. So yeah.
Here was the problem. Here's the problem with Tesla. Once the report dropped, as you said, was a muted reaction. The stock didn't move, and we started moving after Elon announced getting back to Tesla or shifting his focus back to Tesla. But on Friday, I looked at the gamma levels on the stock, and bro, all of a sudden I saw positive gamma on Tesla, and this is why we saw this gamma squeeze up 9-10%, which made sense for me. But the question is, are we gonna see a follow through here? If yes, we can. We trade the tape. We trade what we see, even though we know that the expectation
Fundamental
that the numbers
stories.
are bad. Yeah, the fundamental story is bad, but market's expecting everything to get better because Elon's returning. So we're gonna trade it this way. This is what we do, like from a trader perspective.
Yeah, if we look at the mechanicals, the technicals, as you said, with the gamma regime that we are now in, the positive gamma regime, it's yeah, market is going to be or going to expect or it's looking like the market is expecting a positive shift, a shift back to another push up. Also on the
Especially,
SPY, right? Or
yeah, I want to mention, especially on the SPY, we have right now like 550 on the SPY ETF. Above it, it's back into positive gamma. And if we see acceptance and more calls getting purchased above that price, more open interest, you could expect a gamma squeeze where you see the SPY is pumping 2, 3, 4% back to 570, 560, 580 maybe. And then we see from there, because we still got like around 70 days, 75 days, I believe, till the tariff pause ends.
yeah,
And till then, I don't see no catalyst that could change the picture to the upside or even sideways. Or maybe if we get bad GDP print, I don't think it's gonna be that big of a deal unless the number is way, way too big on the miss side, because we already know it's already priced in from the Fed of Atlanta that we're gonna get bad GDP number this quarter. Unless it gets like unless we see a reading above it, I don't see the scenario where the GDP number is gonna be that important because it's already priced
Question
in.
is, based on the GDP reads, how will the Fed react, or how will the market expect the
Exactly.
Fed to react?
Yeah.
Like cut
Plus,
or hold or yeah.
exactly. Plus, we got like on the like now the SOFR curve is pricing around 90 basis points worth of cuts, depending on the reading we get on Thursday and on Friday, because Friday we get the NFP. We will see how the SOFR curve is gonna react to it, and maybe we could be pricing out some interest rate cuts. And I
So
think
saying
right now,
if we get a solid
solid
GDP
reading, we
reading,
could, yeah,
then cuts will
exactly.
get priced out.
Plus, the GDP is also important to look at the sections because the market is expecting the import number to be the big one that is gonna cause GDP to dip into a negative territory because of the all of these gold imports we had. There was an arbitrage opportunity back at the beginning of the year between Shanghai and the US. And this is why we saw these gold imports also from London Bolts. They imported a lot of gold. It's quite, we can talk about it in another podcast when we talk about gold in details. But this is why also the import section of the GDP reading is going to be negative. The most important thing is to look at consumer and at government expenditure because now like Trump had 1 quarter since the 20th of around 1 quarter since the 20th of January to see the government expenditure. Is it gonna come in lower or is it gonna come in higher because they basically want to cut spending. And this is also the dilemma that we're in right now. We have a problem with imports, problem with the government expenditure, the G section of the formula. And soon enough, with this lack of confidence and this uncertainty that the companies mention in their earnings reports and earnings calls, now you have a problem also with the investment, private investment. And if you look at the consumption, the consumer sentiment from Michigan, it's deteriorating every single day. And now you have the
Yeah.
fourth component, which is also the C. All of a
Also, the
sudden, GDP is now
companies,
negative.
yeah, also the companies saying, for example, on CMG Chipotle on their earnings call, they were also seeing a weakening kind of discretionary spend because now one of the first things that people pull back on their spending if there's further uncertainty or if they are saying, okay, we're earning less or the economy and overall is their financial situation is worsening. One of the first things they pull back are these discretionary spends, these luxury spends like going out and eating. And Chipotle, they were saying that they are seeing somewhat weakening in the discretionary spend on like their dining and so on, and also the part of the government expenditure, of the government investment, the money that the government puts into the economy. On the earnings call of IBM, a lot of analysts were asking them about their consulting part of the business because the consulting, a lot of it's, they do a lot of consulting for companies as well, but consulting in general, linked to the government, no, they consult the government a lot, is also a point where if there's a spending cuts, consulting is one of the first things that get cut, especially in the government. We've been hearing Elon Musk and Donald Trump saying a lot, oh, we want to cut wasteful spending, and a lot of wasteful spending is consulting. So then IBM, they were also saying that yeah, they see that there is a risk that the spending on consulting will get cut. But then they, on the other hand, they were also saying, okay, a lot of our consulting is kind of essential, so there is no way to cut that. But we will see how true that actually is, if it is essential, or if Elon Musk would just say, all right, fuck it, we're gonna cut everything, and then we'll see where we go. And then this consulting stuff, especially for these tech advisory companies or companies that do a lot of IT services, um, the companies like any kind of industrial companies or whatever that have a lot of tech consulting, as I said, consulting is kind of a discretionary spend. It's kind of kind of a luxury spend where you say, all right, we have money now, let's get some consultants, what can we improve and so on. But it's not an essential spend. So maybe these consulting companies that do a lot of this IT services consulting could face some headwinds if we see a pullback in investment, a pullback in discretionary spend, not only on the consumer side, but also on the corporate side. Yeah.
Mhm. So I'm just looking right now at the XLY XLP spread. We're trading about 2.46. The highs before April, the 2nd of April, where Trump announced the reciprocal tariffs, was like 2.49. Like we are almost back to these levels. And we see now discretionary, as you said, like from a trading perspective, we're outperforming staples. This could be also a sign like we are switching from risk off into risk on. Here's the
Hmm.
problem. Like we got this inflation reading, which was in deflationary territory. And in our macro model, like we have four regimes. And after stagflation, usually we see deflation. But also there is another scenario where we could go back from stagflation into reinflation. And this is what I basically wrote down into the 2025 outlook at the beginning of the year. Because right now, everyone is believing, okay, we could see one time increase in inflation, which is going to be transitory. Here's the problem. It's actually right. You're going to see one shot in inflation and it's going to stop at this level because inflation is nothing else than the rate of change in price increase. So the Fed usually look at the inflation rate because they try to anticipate the speed of the increase of prices. And this is why they react to it with increasing interest rates. This is why we look also at and we compare it, the rate of change between two monetary policy of two different central banks to extract our FX rates, for example, which is one main aspect. Here's the thing. We got like, let's compare it with another country. Let's compare it with Europe, with Germany here. We got on one side, as Madame Lagarde said in her press conference a couple of weeks ago, that the European Union is going through a demand shock. In the meantime, what's on the other side of a demand shock? A supply shock. Here's the problem. It's not one-time supply shock. It's a permanent supply shock because it's going to be for the next 3 to 4 years. And an example for this, it's like the war in Ukraine, where we had 2022, where Russia invaded Ukraine. We had here in European Union and Germany, in France and Italy, we had also a supply shock of oil, which caused prices to shoot up extremely higher from like $65 a barrel to 120. And we had higher inflation. Problem is, this was transitory, and we knew it's gonna fade away in the couple months, maybe year, when everything resolves itself and everything cools down. With this tariffs, it's gonna be also a negative supply shock. The only difference, it's gonna stick for the next 4 years, which makes it permanent and not transitory. And what will happen if Trump wins again the next term, or if the next administration doesn't change anything on the
They
tariff
continue with
policy?
this policy. Yeah.
Yeah, exactly. So it's going to be a negative supply shock. Now we got two economies diverging from each other, Europe and United States. And also like the path of monetary policy, the Fed is on hold. Meantime, the ECB has been cutting very aggressive and they're going to continue to cut. Market is pricing like rates by the end of 2025 to be at 1.7, I think, 1.5, which is another like 70, 60 basis points lower. Meanwhile, the Fed is still on 4%, 4.5. And if we get good data, the Fed maybe only going to cut one time or two times this year, looking where we are right now in macro. So we could see that, especially if inflation starts ticking up, because it's going to take time to translate from the day of announcements into the real economy. There's a lag effect. And if we start seeing higher inflation again, also the consumer is expecting higher inflation, which is like a self-fulfilling prophecy, as we always talk about it, when they start spend more because they anticipate higher inflation, and then
This
here you got
causes
it.
higher inflation. Yeah.
Yeah. This is what causes actually higher inflation. And then you got it. You got your inflation is higher. The Fed can't cut. The Fed should hold because the labor market is still till now looking good. It's not bad. The only problem that we got, even the PMI is still looking okay. Like
Mm.
even the,
We're
the
still
PMI
above
is,
50 and everything.
yeah,
So,
yeah, it's still looking okay. It's contracting, it's slowing down, but it's not in a contraction territory. So I see two economies diverging here, and I expect the United States to dip into a reinflation scenario where we see another inflationary episode. Maybe we are not going to see 5, 6% inflation, but 3 to 4% could be reasonable. And with that, the Fed can't cut. They're going to stay on hold, and the European Union or the rest of the world, they're going to continue cutting, especially in Europe, the ECB. And now you got a divergence in two economies. One is deteriorating because there's a demand shock, and the other is there's a supply shock. They're gonna
and
hold. And what's
how
gonna
would you
happen?
play
Hmm.
this? How would you play this
Okay,
scenario?
so from a trading perspective, I would like we are right now starting to position ourselves long dollar, short other currencies, especially like the euro. We are short because going into this, let's recap what happened. We got cross flows leaving the United States because we got this idea of United States isolation. We had no. Let's start at the beginning of the year. We had this U.S. exceptionalism. There's only the U.S. You can only invest in the United States. Blah 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 blah. A couple months later, the sentiment shifted completely into United States isolation, and no one wanted these equities. No one wanted these
This is what
um,
we Yeah, this is what
assets,
we saw in
U.S.
the
denominated
year
assets.
where like
Yeah,
Europe outperformed and so on against the
exactly,
US. Yeah.
exactly. So, but now looking at it, the dollar is down like almost 10% from its peak. You know, the Fed has no permission till now to cut. They are waiting for permission to cut. And if they don't get the permission, they ain't gonna cut because it's gonna look political and
Permission
because of
from the
Trump.
data. Yeah, like
Exactly.
it even gets worse for them because they have to prove that this is not a political cut, that Powell is
Exactly.
not forced. But I don't believe that Powell will let himself be forced to cut or anything. I don't. I mean, this is kind of speculation only. But
Yeah.
Powell does not seem like he's going to cave into the pressure from the Orange Man. So yeah.
So yeah. So we got these two divergences. We got also divergence in monetary policy path between the ECB and the Fed. And the question is, if we see good earnings, we're gonna see cross flows getting back into the United States because all with all these uncertainty and all these negative sentiment, they still manage to deliver good readings, good numbers.
Yeah.
So I don't like um, for me it seems like we're gonna see a couple months worth of rebound in the dollar, like 1 to 2 months, where we see the dollar is gonna go up and we see some cross flows getting back into the United States until these tariffs get resolved or until the 70-day break hits. And then we got the debt limit in June,
Oh.
I think. And then last time it was 2023, we got a credit downgrade from Fitch. I don't know if we're gonna see another credit downgrade. Maybe it's possible. Like I remember it, 2023. Um, could be possibility. If this is the case, this is gonna be very bad because no one wants to hold treasuries, and we're gonna see the same behavior of prices that we saw in the last couple, like 2 to 3 weeks. Money is gonna leave the United States and go into the euro because now everyone on the street is talking about euro to be the second reserve currency
Hmm.
if something bad happens. But this rebound story in Europe, like we saw it in the PMIs going into this year, if you
It's
remember, we
changed
had
again.
this, yeah, we had this thesis that we could see an increase or a growth rebound in the European Union because we went into a deflationary period, and after deflation, you see some growth rebound and all that type of stuff. And now we are dipping back into the deflation scenario, which is gonna cause the ECB to cut even more, to stimulate even more, which is going to encourage, by the way, risk taking in Europe at some point. If they announce QE, we're going to see European risk assets rallying. Till then, I think the euro here at 1.16 against a dollar below 100 could be a beautiful, beautiful trade, especially because you're gonna get paid to take it. You
Yeah.
receive the carry. If you open a trade, you receive the carry. So why not? Just try it. Like we just tried it. Don't try it. It's not a financial advice. Don't
Yeah, yeah,
try.
obviously. This is just a talk, just yap,
Yeah.
of course.
We are just chatting here, like what we think. And we get this week also my boy Ueda himself again. This is also
Wait, are
quite difficult.
gonna make us sit for some data again, like at 4 a.m. Then there's gonna be half an hour delay with the data, and we're gonna
Yeah.
just be there half dead in the middle of, or not the middle of the night, in the early morning, just sitting there.
Yeah.
Where the fuck is the data?
Like bro, I remember like it was last or the not last one, the one before the meeting from the BOJ. We got also CPI at 1 a.m. here in
Yeah,
Germany. We stayed awake all night for us to make $0 because the data came in delayed and the end didn't move basically.
yeah,
Even though they hiked like by 50 basis points. That was insane. So
yeah.
like
We were
for
ready
them, yeah,
to shoot the bazooka, go big on that.
yeah.
And then firstly we're sitting there 4 a.m. waiting 4 a.m. Then it's 4:05 and we're just sitting there, nothing happening because the data is not getting released. Half an hour delay, 4:30 a.m. The sun nearly already coming up, and we're just sitting there waiting for Ueda. But yeah.
Yeah, so it's gonna be again another interesting meeting from the BOJ to see what they're gonna do because from if you look at the Tonya curve, it's pricing only like another 11 basis point worth of hikes only. I don't think it's gonna do anything significantly to the yen unless we see another deleveraging episode in the um, in the global markets. So we are now moving slightly out of risk off into like I would say slightly risk on. And I don't see another deleveraging episode like we saw after Trump reciprocal tariffs got announced. So maybe we could also take a um, short in the end. Like by the way, my quant is working also on a Python model that also with generative AI. Like we use some deep machine learning and machine learning strategies to train this AI, and our system flipped bullish USD GPY at 142.99, like 143 basically. Um, so we will
Risk
see.
on.
Risk on, yeah, exactly. So because it's a carry trade, it's a leveraging trade. It's a leverage trade that you're taking. Is it gonna stick? I don't know.
Yeah.
Um,
This is the whole
because
thing, as we have
yeah,
been saying all the time now recently. Who knows? Who knows? But this is what we do. This is what we currently play.
yeah.
This is what we see. So we got to trade what we see. And then once the story changes, and then we trade what we see. It's difficult to give an outlook for where we're going to be with certainty. But if you're positioned right, if you're ready to adjust, and if you know what's going on, and if you know how to adjust, then yeah.
Another thing is trade with small positions. When vol is so high, trade small position size. Like there's a reason why VIX is trading at 60. Like it's like I saw some traders, which is insane, going with the same position size where VIX is sitting at 60. Like, are you insane? Why don't you drop like your size by half and just try to get a feeling for the market, try to survive these
Survive
periods
these,
of
yeah, yeah,
uncertainty?
yeah.
Exactly. And then you can get back with leverage when certainty is back on the table and make more triple your money, like even 5x your money, you know? I don't get it.
I
This is
think
why
it's
we take
somewhat of the greed. If you see these huge moves, SPY moving 10%, and then greed kicks in, then you're gonna be there like, oh, I want to go full big into this because imagine if I'm in a position and it moves 10%. But this is also the greed outweighs
logic.
the caution, the logic,
Yeah.
where it says, "Oh, I could make 10%, but I could also ruin and get a margin call, ruin my account and get a margin call." But then you're just looking at the greed side, and then you're like, "Oh yeah, let's go full leveraged."
These are gamblers, bro. Like, because here's the point. If you drop your size by half, instead of making like 5% return, in like let's say 2 months or 1 month, depending on what your product you're trading. If you drop your size by half, the SPY like the Nasdaq moved from bottom to till Friday's close 16%. This is on a regular year. This is 1 year performance. If you
On a
took it
good
to
year, that's 1 year
yeah,
performance. Yeah.
yes. So if you took it with half the size or even one-fourth of the size, you still made enough money. You're still good to go. There's still
Yeah.
opportunities. But try to survive these periods, folks. Don't blow it up. Don't go like we come from a different aspect. We come from a different perspective. We try to do it like professionals, like the CFA guys does, the institutional does. But for the retailer out there, if you're a retail trader, don't blow your account. Because if you blow it now, you have nothing to fight with when everything settles down. You need to have your ammunition to be ready to shoot bazookas
Once it gets
when mark.
clear
Yeah,
and yeah.
exactly. So with that said, oh, before we end this episode, I'm out of gold by the way. Like I got
Yeah.
out at 3,500. I think for me,
No,
it's
you
like
got
we
in
could
at three
see.
five hundred, but we got out. So.
No, I got out
Oh, you mean
from
you're
my
long?
long,
Ah,
my
yeah,
long
yeah,
from
okay,
the
okay. I
beginning
thought you
of the
meant our
year.
short.
Yeah, I got out and I saw, bro, like I went on Twitter, by the way. This is why went guns blazing into the short because I went on Twitter, and usually if you trade gold, if you understand gold, gold doesn't move like a meme coin. It doesn't go usually parabolic. You can plug 200 days moving average, 50 days moving average, and see the distance between the price and the moving average. This is basic technical analysis, by the way. So, and then I looked at the positioning. It was at an extreme. The stock went parabolic. Multiple technical indicators, if you look at the RSI or the MACD or the Bollinger Bands, everything is overbought. Look at the positioning. The IV is on the call side way, way, way too high. No
Yeah,
one is
skewed.
willing
Yeah.
skewed to the call side. And then I went on Twitter to look for the sentiment around 40,000 hashtags with gold on new all-time high. 40,000. This is gold. We are not talking about a meme coin. And I
Yeah.
was like, okay, now you know what? Like I saw it. There was a gamma positioning at 3,500. Let me get out and let me turn it into a short. And it paid out very big, very, very big. So I'm out of my gold position. Torben, before we end this, we got like a couple seconds left. Any last words? Anything on the earnings side? Very quick.
What I'm looking for, um, as I said in the beginning, Thursday, Apple and Amazon, due to their China exposure. I'll also be looking for these consumer staples, what they say, Coca-Cola, Mondelez. Then we like what they say about the consumer. What to look for is also consumer discretionary, similar to Chipotle. We got Starbucks on Tuesday. No, because if you have money to spend, you go to Starbucks, waste your money on an $8 coffee. But if you're no, not so certain about how much money you're going to have, you're going to pull back your Starbucks spend. So yeah, those will be interesting. So consumer
Perfect.
staples, consumer discretionary, and then China exposure stocks on Thursday.
Okay, perfect. Thank you, brother. With that